Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today again is the professor himself, Mr. James Zhang. James, how are you?
I'm doing good, Paul. Thanks for having me.
What's going on in the Old Capital world these days, James?
We just wrapped up our conference here in Dallas, and it was, we had 350, 400 folks come down and see us, and it was a good time. We had it over at the soccer stadium here in Frisco and got to hear from everybody, listing brokers, lenders, property managers, general partners, limited partners. And the number one thing that people came up and said was like, man, this was pretty raw. We weren't holding anything back this year, I guess. I think it was a good turnout, and we like to speak about reality here at Old Capital.
No, absolutely. We try to keep it as real as possible for people that are not really too familiar with real estate, and then bring it to the next degree. There's different flavors, different levels of commercial real estate, and whether it is multifamily, which we kind of figure out how that works, or office or retail or warehouse or short-term rentals. We always try to get everybody up to speed about what's going on. So today, I thought we'd try to keep it as real as possible. And that really is talking concerning how to actually make some money in real estate. It's not what you make, it's what you keep. In the podcast today, we have two professionals that try to keep as much money of your money in your pocket as possible. So I want to have our two friends from Keystone CPA out of Southern California enjoy spending some time with us. So that's Amanda Hahn and Matt McFarland. So guys, thanks for joining. We certainly do appreciate you spending some time with us today on the podcast.
Yeah, thanks, Paul. Thanks, James. Thanks for having us. Appreciate it.
Yeah, excited to be here.
So I'm going to turn it over to the Grand Inquisitor, and I'll jump in. James.
Yes, maybe to kick it off, give people a little of your background, sort of where you guys are based, and what is a typical day in the life for you guys.
Well, what I tell people is that we are CPAs by day and real estate investors by night. So just like our clients, we also invest in real estate ourselves. But our passion really is in educating folks on how to tap into the tax benefits of real estate investing. So if you're already a real estate investor, how do we optimize the tax benefits of doing so? Or if you're just someone who loses a lot of money to taxes, how do you then get into real estate so you can not only build wealth, but also save on taxes?
Yeah, both of us got our start at one of the big four accounting firms. And I think we kind of took the approach of where they did tax planning for high net worth individuals, billion-dollar companies, right? And we took that and we wanted to apply it to the kind of the mom and pops, the everyday real estate investors. And so that's what we try and focus on at our firm at Keystone CPA. We've got real estate investors are spread out all over the country, and we really just help them do proactive planning and kind of, as you mentioned, keep more of what they make and use that money, continue to reinvest, build their wealth.
So I've got a couple topics here, and I'm just going to sort of throw them out there and you guys knock them out here. So first, let's maybe just start with mistakes that you've seen people make in the space. I'll just leave it at that. I could go a lot of different directions, but maybe mistakes you guys have seen, and then we'll go from there.
I think a common mistake I see made, and I don't know that's made by investors, but I think a lot of investors assume that the person who files their tax returns is doing tax planning for them. And it's important to understand that those are two very different things. We all get our taxes filed. And when you file your tax returns, you're basically reporting what happened or didn't happen last year. But to truly save on taxes, you should be doing planning. And planning is taking a forward look to say, okay, what do I have going on? What am I going to invest in? Who am I going to partner with? How am I going to tap into the equity? And it's in those investment decisions where strategies become available. And especially in the commercial real estate space, I think a lot of investors assume that their CPA is doing strategies for them, accelerated depreciation and entities and all that. So a tip I always tell people is don't assume, don't make that mistake and assume, ask your CPA. If you think you are using a strategy, ask them, how much did this strategy save me in taxes last year? Right? Be specific about your questions.
All right.
I think for me, what comes to my mind is that investors don't approach this like a business a lot of times. So they're just, oh, well, it's something I do on the side. I'm just investing. But from the mental side of things and how you approach it from a business side is it helps you to keep track of your finances better, make better business decisions, make sure you're maximizing deductions, not missing out on things. We could run through the whole list, but I think that's what I see too, is investors just not approaching it as a business.
All right. And then in terms of, I'll just throw out, let's, a lot of people that we run into, I think, are maybe there's one spouse that is a high income earner, whether it's a doctor, lawyer, accountant, what have you. And then the other person is a real estate professional. So in that scenario, what do you guys see works well when you consult with those types of people? And then what maybe do they not have set up in that situation? Because that seems to be one of the more common.
It works best when the spouse who's doing the real estate is one who likes to do real estate. That's for sure. Because that's not always the case.
Yeah.
I think it's important to obviously start with the reason, right? I mean, what you just mentioned, a high income earner and a spouse who does real estate, they're able to use what we call the marriage tax loophole, which means if you qualify, if one person qualifies as real estate professional, now you can use rental losses to offset all of your income, your total income. Even though the doctor, for example, doesn't do anything with respect to real estate, they could use the tax losses from their joint rentals to be able to offset income, right, from the medical side. And that's kind of the golden area where we would love all clients to be. But I think what Matt said was true, that it's not always the case where the non-working spouse is interested in real estate. So as CPAs, sometimes part of our job is to show them the numbers. So you might have a reluctant spouse who's like, you know what, I don't know if I want to do real estate. But if they look at the numbers and say, hey, if you just did do real estate, then maybe you could cut your tax bill by half, right? Or more than half. So incentivizes them with the numbers.
Is there anything you want to say about real estate professional status for that spouse? What is the easiest way to qualify for real estate professional status for a spouse like that?
Yeah. Well, I mean, just to define what real estate professional means.
Yeah, I mean, in the tax world, there's a couple rules people have to meet to be a real estate professional. So one, they have to spend 750 hours a year working in real estate. Now, this can be working on rental properties. They could be a real estate agent as well. They could be doing fix and flip, wholesale, kind of runs the gamut, right? The second one actually is not going to apply to the person who is the stay-at-home spouse. The second test, you spend more time in real estate than any other job. But again, if they don't have another job, they don't have to worry about that. And then the third one, which is just equally as important, is as part of their involvement, they do need to be involved in kind of the day-to-day operations, management of their own rental properties. Now, that doesn't mean you can, if you have 10 rental properties, you got to be involved in the management of all of them. You got to be involved enough to meet the requirements. But sometimes we have clients that have out-of-state rental properties that somebody's managing those for them. But maybe they've got a local property or a couple local properties that they are spending their time on that. That's a bulk of their time. Maybe it's a midterm rental that's got a lot of turns and they're spending their time there to get their hours. So there's different ways to do it, but those are kind of the requirements. So I think that kind of helps frame the thought process.
And I think a lot of people assume to be a real estate professional, you have to be licensed as a realtor or broker. That's actually not one of the requirements at all. It's only the hour stuff that Matt was talking about.
Okay, and we usually don't touch on this, but I feel like it's a big thing is there some sort of short-term rental loophole in this game?
Yes, for sure. One of the issues, as you can probably already imagine with real estate professional, is one of the requirements rather is you have to have more time in real estate than your job. So what if you're a single person and you can't marry a stay-at-home spouse, right? Or if maybe you are both high income earners and you don't want real estate to be your full-time job, you want it to always kind of be just the side thing you're investing in. And so we see that a lot with like two physicians who are married to each other as an example. So in those scenarios, that's where the short-term rental loophole comes in, because if you invest in short-term rentals, you do not have to be a real estate professional to use the losses against W-2 and business income. You just have to meet material participation. So there are still requirements where you do stuff with respect to your short-term rentals, but what you don't have to do is you don't have to have more time in real estate than your job. That's where the floodgates open up for a lot of our clients who are, they could be in any industry. They could be teachers, they could be athletes, they could be social media influencers, doctors, CPAs, and use the STR loophole because they could keep their full-time job and just do real estate on the side.
I'm going to steal that and say, usually when I say doctors, accountants, lawyers, I'm going to add social media influencer to my list of high income earners out
There
there.
you go.
Okay, let's move over to like our typical structure is GP LP. They're buying a $20 million deal and they're raising $5 million in equity from LPs. So in that situation, let's take it from maybe the GP side. Is there anything that you see on the general partnership side that they should be concerned about, or is it similar for GP LPs out there?
No, it's a very different structure. One of the main things that we always talk to our clients who are on the GP side is to understand that as a general partner, you sort of wear two hats for most of the time. One is on the active side, right, where you are raising money, you are getting acquisition fee income, asset management fee income. So that's all active income for tax purposes, which means that's the income you pay income tax as well as self-employment or payroll taxes on. And then separately, most of the GPs also they have skin in the game, so they've invested passively as well. And that's your other hat is I am also another investor, just equity wise with respect to the deal. And from a structuring perspective, what we typically recommend is you have those incomes flow to different entities. So where my rental losses coming through my LLC as it normally does, but for my active income, the acquisition fee, all the different fee income running it through a different entity, for example, a corporation, so that you can protect that from self-employment taxes. And that's something that unfortunately we see missed quite a bit on the syndicators side. And I think part of that, again, is probably just lack of planning. When attorneys set it up, they're not looking at sort of the tax consequences of it. But I think splitting those up is significantly beneficial to reduce self-employment tax, but also preserve the rental losses through the use of two different entities.
So when the lender gets the org chart and there's 10,000 entities on the org chart, it's because of CPAs. Is that what you're saying?
Sometimes, yes.
We'll blame the attorney.
CPA
We'll blame
plus
the
the attorney.
attorneys.
Okay, CPA plus the
Yes.
attorney. Okay, and then go to the LP side. LPs, they have an option. Talk about how people take title into their investments into these syndications.
Yeah, certainly. I mean, we've seen it done lots of different ways, right? Now, coming from a tax perspective, people could invest either in their personal names. Maybe they've got their own, let's call it single member LLC. They're using that to invest in. Maybe they've got some sort of partnership holding structure that it holds all their investments. We've seen it done different ways like that. At the end of the day, if they're an LP investor getting, call it rental income, passive rental income, from a tax perspective, it doesn't technically matter whether they hold it in their personal name or through one of these LLCs. But again, an attorney might recommend, depending on their situation, might recommend holding title via an LLC for an additional layer of asset protection or something like that.
Okay, so the way it flows into you doesn't matter in terms of.
Yeah. For tax purposes, it doesn't matter. Now, there is something really interesting. You guys might have also heard this too, which is a lot of CPAs will tell clients that there is no tax benefit when you are just a passive investor in a real estate syndication or a fund because you're not a real estate professional, right? So the people who invest passively a lot of times are the high income earners who are not doing real estate full time as an LP. And the issue we have with that statement is that when you're told that by your CPA, they're strictly looking at your rental loss from the syndication is not offsetting W-2 income for tax purposes. We all know that when you invest as an LP in a syndication, if the deal is right, then you're earning cash flow, right? Cash flow, there's cash flow. And those are still able to be protected with depreciation, even though you're purely passive. Same thing with respect to appreciation, right? We don't have to pay taxes on any of the appreciation as passive investors until you sell. And even in the worst case scenario, if a deal just underperforms, there's never any taxable income, and eventually we sell for a loss. What a lot of people don't know is that when the property exits, when the entity is dissolved, all those losses that they weren't able to use is able to offset W-2 and other income in that year. So there's always a benefit to investing in real estate, whether you're a GP or LP, active or passive. The only difference is timing. When do you get the benefit?
Okay, and then, I know we're coming up here towards the end of the year. Is there, and Trump passed his big bill, big beautiful bill is what I think it's called. Was there anything what were sort of the big changes for real estate investors out there I feel like he just kept everything that he did like 7, 8 years ago. I feel like he just put a stamp on permanence with his bill. But
No,
tell
there's
me,
there's definitely some things in there that were kind of, we'll call it extended.
okay,
I think the big one that came back for real estate investors has to do with bonus depreciation.
okay,
That bonus depreciation is kind of the ability to take a much faster write-off on certain items now. And years ago was like certain items you could expense 100% right away, and then it was dropping to 80%. We were down to 40% this year, but with the one big beautiful bill, brought back 100% depreciation. So for properties bought and placed in service after January 19th of 2025, certain assets in there in like, multifamily property, right? Somebody goes, there's appliances, there's furniture, there's carpeting, whatever you want to, fixtures, things like that. That's the kind of stuff that if somebody did like a cost segregation study on a new acquisition, their depreciation benefit this year is more than doubled it would have been had the one big beautiful bill not passed. So that can have a huge impact on investors. We have a lot of investors being obviously aggressive after the bill passed to buy more properties just for that reason.
okay. So bonus depreciation. So it went from 40 back up to 100, and then so I guess going forward next year is it still 100? It's still 100 every year forever.
Still 100 under the permanent rules, right? Like
Until something
Forever until
changes.
the next
Okay.
election.
until something
Yeah.
changes. Yes, it's
All right.
permanent until it's
Okay.
not permanent.
Anything
Yes.
else in that bill that was big for real estate guys?
I mean, the other thing, I think two other things that are notable, not brand new, but more of, extension or just additional ability to utilize it. For those of you who are GPs on deals, the ability to use qualified business income deduction. We have that from continue to have that from 2025 and beyond. And that's basically where up to 20% of your real estate income could potentially be tax-free. I mean, I mentioned GP, but that also applies to rental income as well. But we typically, because rental income usually offset by depreciation, typically where we see this as a big benefit in practice is offsetting all the fee income that's generated. Acquisition fee, asset management fee, up to the first 20% could potentially be tax-free.
Along those same lines, for those people earning active income, another extension from the one big beautiful bill was the pass-through entity tax break. Entities are allowed to pay the state taxes that the partner or shareholder would owe on their profit. The entity can make that payment directly to the state and take a federal tax deduction for it. The benefit of that is that it avoids kind of the state and local tax cap on the personal side under itemized deductions. So for a lot of those active people with deals making profits owing state taxes, I would definitely recommend having the entity look into doing that.
I think for the syndicators, if you're a GP, this is very beneficial on real estate exits. If there's going to be a capital gain on the sale of a property, because usually we see a big capital gains event because of cost segregation, took all the depreciation already. So just making sure you analyze that to the extent possible, have the entity pay the state taxes for the investors. That helps to lower taxable income for everyone, GPs and LPs.
So as soon as you said state income, like my brain shut off because I'm in Texas.
Yeah.
But
Right.
if that, but I guess when does that come into play? Is it more where the property is though? Like if you invest in a property in, let's say California, I'll just use that since you guys are there. If you invest in a property in California, does the whole state income tax come in there, or is it more where the investor is?
It's a couple of different things.
Okay.
First and foremost, where the property is located, right?
Okay.
There's
Yeah.
if you live in Texas, but the property is located in California, then there's California taxes assessed regardless.
Okay.
So that pass-through election does benefit you. Also, sometimes it also depends on where the GPs reside, because where the GP resides is also where business is being done, right? Decisions are being made.
Okay.
So that's also another indicator of where it is too. So I know you say you turn off your brain, but you probably have investors out of state. You probably have.
But if the property is in Texas, let's say the property is in Texas, there shouldn't be any state income tax for any investor, even if they invest from New York, or no? Or no, they still pay state income tax. The guy from New York.
Yes.
All right. Gotcha.
Right. So California, for example, taxes worldwide income. So California doesn't care where the property is. It's going to pay taxes in California.
They don't care where you are. Yeah. They
get you everywhere.
So big, beautiful bill. You said bonus depreciation is 100%. I got that. And then you slipped in QBI, or qualified business income, which everyone should know about it, but I think let's use that example. You get an acquisition fee of 200,000 and your entity takes it, and then you're thinking, you can maybe get a 20% deduction before it gets to your personal using an entity. Is that right? Am I thinking?
Yeah, basically you would get a deduction on your personal return for $40,000 in that
40,000
example.
on that 200,000. Okay, I got you.
Yeah, so
But
I
you've
have to
got
pay
to have
tax
that
on
set up
160.
to make sure you take the income the correct way. You can't just accept
Yeah,
that income.
it's based on the type of income. So that
Yeah.
one actually doesn't have to have an entity. Some people get 1099 income that could qualify on their personal return, but
Okay.
it comes down to the type of income.
Okay. So we've got a couple months before the end of 25. Is there anything that real estate investors, GP, LP, individual owners, we've touched on a lot of different folks here so far, anything sort of before 2025 to get into this year or even prepping for 2026 that people should be aware of?
I mean, year end is a very significant point in time for tax planning because effectively where your numbers stand on December 31st determines how much or how little taxes you pay next April. So I'll talk about some of the LP stuff. You know, if you're someone who maybe had large income from your own rental properties or you invested in a syndication that had a huge exit where there's capital gains coming to you, something to consider is maybe redeploying that money, right? Typically in syndications, we can't 1031 exchange, but what you can do is what we call the lazy 1031. So you can just take some of your money, reinvest it in other syndication deals. And if that new investment is going to kick off tax losses from cost segregation and things like that, those losses can offset the income on the other gain properties that's exited. But timing is key. It has to happen before the end of the year because we need the income and the loss to happen in the same year.
Okay.
Along the same lines, I would just encourage people to have that open conversation with their tax CPA just to, hey, what's happened during the year? What has gone on? What are your goals kind of in the next 12 months? What are some of the moving pieces so they can plan accordingly? Because that's where kind of the good stuff comes out of that conversation. Like, oh yeah, now we can think about selling this or buying that or whatnot, you know.
Okay. Paul, I'm going to open the floor up a little bit here. Anything that we did not hit on or that you're thinking about?
Well, I'm always thinking about different things. And when I listen to Amanda and Matt, I think in terms of a Swiss Army knife. And the perception is that a CPA is the same, that they do accounting and they do tax returns, but they may not do tax planning. When you take a look of a Swiss Army knife, there's a lot of different pieces within the Swiss Army knife itself. There's the knife, there may be the fork, there may be different things in there, but you really need a specialist, a real estate specialist. Because if you had a law problem, would you go to an attorney that was only an environmental attorney to help you with a personal injury or a bankruptcy? Or would you go to a criminal defense attorney? So when you use that word, I go to a CPA, that CPA really is just a generalist. They're not a specialist. And in these type of transactions, when we deal with real estate, you need to go to a specialist. And things that Matt and Amanda talk about are specialties. If you listen to what they're saying, they're not the Swiss Army knife. They're the knife. They're the ones that you need when you get into real estate. They're the ones that are not just giving you the accounting. They're not just giving you the tax returns. But what they're doing is they're helping you with tax planning. So they're a specialist, just like you have specialties in tax in being an attorney, their specialties are in real estate. I always love to make sure that we're talking to the right people when your money is involved, and you want to make sure that you're talking to a specialist, and that's what Matt and Amanda are. Amanda, any funny stories? When I say funny stories, it may be funny for you and I. It may be tragic for other people that have found themselves in this situation, but I always learn by listening to people that have had problems. And it's something that I always remember when we kind of converted over from somebody else's tragedy to something that we can take away some words and pearls of wisdom of what people have gone through that you don't want to go through in the future. So, Amanda, I'll open it up to you. And I know Matt always has some great stories about problems that their clients or what they've heard from other clients have had problems with.
I'm just thinking about how I'm going to be telling clients I'm the knife now. So I'm going to be using that going forward. I'm just going to work that into the dialogue, right? But
I don't know if I have a funny story. I have more of a horror story of my own, but I think it's probably good to share just so other listeners can learn from the mistakes. So, when we first started out investing in real estate, we wanted to start with commercial real estate. And it was very new to us. Went to an event and heard somebody on stage who was raising money for multifamily. Guy seemed super nice, amazing. It was his first deal and his first time, first time doing syndication, first time doing multifamily.
Sure.
And just, we really liked the guy. And at the time, we didn't have a lot of money. So I took money from my work 401k and I moved it to a self directed account, invested in the deal. Everything was kind of great. Same strategies we talked to our clients about. The problem was the deal turned out not to be so great. They couldn't get bridge financing. So ultimately lost the deal. Not only did we lose money, but I lost money that was in my retirement account, right? And retirement account money is super precious because it was growing tax deferred for us. The lesson learned from that nightmare story was that I realized was we didn't do any due diligence on the deal itself. And we didn't do enough due diligence on the syndicator who was behind the deal. Kind of we fell in love with the story, the rags to riches story. Just because you see someone speak on stage or on a podcast, don't assume that they know everything and they're the best and they're the experts. Always do due diligence when you're giving your money to someone else.
I want to stop, and I know Matt maybe have a story on top of that, but so how do you, in your mind, you had a loss, but how do you, in your mind today, what's the top 2 or 3 things that you're advising clients when they're thinking about getting into bed, so to speak, with a syndicator? How are you clarifying to them about what they should be looking for to make a determination whether they should put that $100,000 into a deal? So what do you think somebody should be figuring out right now?
Yeah, a couple of things always to look for is the deal itself, right? Because it's whether the numbers work in the deal, looking at actuals, putting more weight on actuals versus projections, because projections are sort of just a wish list of what we think will happen. And then doing due diligence on the person behind the deal, because in syndications, as a passive investor, you don't have much control, if at all, over the operation and the decision making. And so understanding who that person is or the people in the GP team, what their track record has been, and even as simple as searching or Googling their name and fraud, their name and SEC, their name and complaints, right? That's the base level. So you get an idea. I don't want to hear all the great things they've done. I kind of want to hear all the bad things they've done. Hopefully I don't find a lot of those.
Yeah. Jay, and before I go to Matt, but James, what's your advice to new investors?
What's funny is I thought you were plugging our butt store, Amanda, about meeting, about how do you get comfortable with a deal? Because I think a lot of people on their first deal, after they've done 5 or 10 of these deals, they're like, man, I don't even know how I made that first investment. I didn't do anything, right? So you almost have to have, we try to shortcut that a little bit in terms of the knowledge and education you need to make sure you don't make a mistake on the first one. Because for some people who started maybe in 21 and 22, they did 1, 2, 3 deals and then that was it. They don't have any more money because those deals aren't coming back. So yeah, we treat it quite special.
So Matt, a funny story or a horror story?
Yeah, we could be here all day. I think one story that comes to mind is kind of, I guess, more of a kind of another learning thing, right? So for one of our clients, they were a big client, a lot of moving pieces, and they happened to get audited, not because of all the moving pieces. They actually got audited because of a missed W-2 that was not reported on the return. So one of the spouses forgot about one of those side part-time jobs they had. And that is what, I don't even remember the dollar amount of the W-2, but it was nominal, right? But that's what triggered an audit. And luckily for them, we were able to help them and it came out clean on the audit. But think about being organized and having all your things in order just to kind of prevent that from happening was a huge learning perspective for them and, and reminding our team and our clients too.
Yeah, I think a lot of people, especially CPAs, will tell clients or sort of scare them into, hey, when you invest in real estate, you'll be audited. When you claim real estate professional, you'll be audited. Short-term rental loophole, probably audited. Cost seg, for sure, you'll be audited. When in reality, at least what we see in our firm, the things that prompt audits are not all those that you hear about. It's actually very silly things like missed W-2, missed brokerage account, a missed retirement distribution. But I believe the reasons for those are because those are, a computer can match those up, right? It's automatically generated. They can match those things up. And for an auditor, if it flags them and they're sort of like, well, I'm already here looking for this W-2, maybe I'll just peek around and see what else is going on.
That's actually what surprised me. Like when you go on irs.gov and you sign into your account, they actually already have everything. It's silly that they're making you file the exact same information.
Exactly.
They already have
exactly.
it. So you can actually go in there, and if you're not signed into irs.gov, and you can actually go see all your documents there, and it should tie out to your tax year. Okay, so what is the best way for people have any follow-up questions, or they want to consult with you guys on 2025, 2026? What's the best way for people to reach out to you guys?
Yeah, the best place to find us is our website, which is keystonecpa.com. We have a lot of good information, free resources on there. If some of the stuff, you guys got really highly educated people, but if there's stuff on there that we've talked about today, they don't know, they can find information about it on our website for sure.
Best place to find me is on Instagram as well as YouTube as Amanda Han CPA if you're just looking for daily tax tips.
I really appreciate you guys spending some time with us. Again, I go back to the theory that when you should have a specialist. So you cannot just think that your accountant that says he's a CPA or he does your tax returns really knows what real estate is all about. So whether it is Keystone or our friends Amanda and Matt, find a CPA firm that specializes in real estate. Again, Amanda has some great content that she puts out there on Instagram and Facebook and all the different social media pieces. But they're hardworking folks out of Southern California that I want you to spend some time with if you do have an opportunity to sign up to get some information from them. So I do appreciate them spending some time with us, Amanda and Matt. So James, any final words before we say goodbye?
No, thank you guys for coming on, and look forward to seeing you in the future.
All right.
Thanks, guys. Appreciate it.
Amanda and Matt with Keystone CPA, thanks very much. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.